Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and one of the biggest, the absolute biggest residential mortgage lenders is now stepping out of the business entirely in the correspondent lending field, which is absolutely outrageous, you guys, because that's something that personally I didn't see coming. And today what we're going to talk about is the impact Wells Fargo leaving the residential mortgage industry is possibly going to have on the liquidity of the real estate market. Because the thing is, guys, Wells Fargo was number one, and essentially it's a battle of the big three. Wells Fargo, which is number one, Wells Fargo wanted since about 2016 40 to 50% of the market share of mortgages. You guys, Wells Fargo loved doing mortgages, so the fact that they left is shocking. Remember, I'm not your financial advisor, even if I want that to be, even if you want that to be, I'm not a financial advisor, even though my bio is someone that wants to stop saying, you guys. But I'm going to do the best I can. So remember, my bio is just as a normal person that is trying to navigate myself and my family through the housing market crisis that we're in right now, you guys. So I have some really exciting content that I'm going to show you guys. I'm probably going to do it on my next housing update video, but I'm going to start doing a few more scenes in the field because, again, remember, I'm in a local housing market right now in Texas that is essentially showing all the signs of the housing market crash. And what I have found right now that is like mind-blowing is the rental market destruction going on in my housing market right now. So again, you guys, I'm wondering, well, like last time we had all the lending restrictions, right, through the Dodd-Frank Wall Street Reform Act. Now that Wells Fargo, the biggest player, and I'm in lending, remember, the biggest player, now that they've stepped out, is that going to make it a lot harder for the entire industry? Is there going to be less liquidity? Now, all of these things are possible. And in order for us to kind of get a better idea of what might happen, we're going to dig into a CNBC article. But before I do that, remember, you guys, I forgot to say, like this video for me, please. Put some comments below, share it, hit notifications. Something's wrong with YouTube. But please, you guys, help me push this message. And the beautiful thing is, guys, is we have saved so many people from making a bad mistake at purchasing a home in the peak. So thank you guys for listening. I'm so flattered. It means so much to me to know that you guys are out there winning. So continue, please, to make comments. And real quick, guys, I understand that people buy for different reasons. I'm not arguing that. Some people may buy right now, and it might be a good reason, especially if right now they're lowballing and getting those lowball offers accepted, right? If they're getting a lowball offer accepted and that's 20% under market value at 2019 or 2018 price levels, it might make sense, right? But it's really hard to find that right now is my point. But you guys, the name of the CNBC article that we're going to read today is titled, Wells Fargo, once the number one player in mortgages, is stepping back from the housing market. So the three key points of this article are, instead of its previous goal of reaching as many Americans as possible, and again, I can confirm this, I'm in residential mortgage lending, Wells Fargo generally had the best pricing. Pretty much everyone had the same interest rate, but they had their interest rates generally for a little bit cheaper. So, to lose that, that's pretty shocking, you guys. The company will now focus on home loans for existing bank and wealth management customers and borrowers in minority communities. So essentially it's saying that they're still going to help existing customers more than likely with purchase loans and existing customers with refinance loans. And they're going to start putting additional attention into minority communities. As part of the retreatment, Wells Fargo was also shuttering its correspondent business. This is huge, you guys. I cannot tell you how big a deal this is. This is the lifeline to so many other banks because, again, remember, it's the big three, Wells Fargo, Bank of America, and Chase. Now that one of those the biggest one has been taken out, a lot of these smaller banks that are correspondent banks that borrow money from Wells Fargo, they're going to hurt. I'm going to tell you guys that right now. They're going to hurt. They're going to have to go to Chase or some other correspondent lending platform. Wells Fargo is also shuttering its correspondent business that buys loans made by third-party lenders and significantly shrinking its mortgage servicing portfolio through asset sales. They're also selling the loans that they do have. Pretty shocking, you guys. Altogether, the shift will result in a fresh round of layoffs for the bank's mortgage operations. Executives acknowledged, but they declined to but they declined to quantify exactly how many jobs will be lost. What we're seeing here is one of the biggest players in residential mortgage fold, and correspondent business for them, guys, was a huge part of their residential mortgage portfolio. So we're seeing now that the massive decline in mortgage applications and the massive drops in sales is hitting even the biggest of residential mortgage lenders. Here's the really, really shocking thing, you guys. We have just started 2023. Now, I know there's been a lot of talk about the pivot and the U-turn and things like that, but I need to remind you guys of something. And here's why I'm not saying go buy, go buy, go buy. We haven't even had our confirmed recession. If we don't go into the recession, the economy is going to break every historical record and indicator of recession in the yield curves, okay? So the fact that all of the inversion over the 10-year, you guys, historically 100% of the time it leads to a recession. So again, the recession hasn't even hit yet. We have just started 2023, and already, you guys, Wells Fargo, the #1 lender, just took a massive, giant step back, and they're about to lay off a significant amount of people. So before I deep dive into this article, I want you guys to listen to what the CNBC banking reporter has to say, and it's only about 50 seconds, but he really summarizes how big a deal Wells Fargo stepping out of the residential mortgage industry actually is. Take a listen.
First of all, the thing you have to know about Wells Fargo is this was their pride and joy, the U.S. mortgage business. This was the generator of a lot of their profits over the years. And as recently as 2019, they were the biggest mortgage lender in the country. So what they're saying now today is, instead of going for everybody they could, and really up to a 40 or 50% market share, which was their previous aspiration under previous leadership, they're saying we're only going to sell mortgages if you're an existing customer or if you happen to reside in a minority neighborhood. And so that's the first thing to know. The second thing to know is there is a business called correspondent lending business. That's where essentially they provide the capital to other firms that sell mortgages under other names. And this is a major pipeline for their business. They're essentially shuttering that business, which accounted for 40% of their mortgage volume as recently as the third quarter. And on top of that, they have a thing called mortgage servicing rights. So it's a huge business for them. And in that as well, that they're going to retrench, and they're planning on selling what is likely to be billions of dollars worth of MSRs to other players in the industry.
Wells Fargo is freaked out about something. They're getting out of the mortgage industry. And it's really kind of shocking as an industry insider, as a loan officer, realtor, and instructor in real estate. I see that, I see how big a deal that is. That is a really, really big deal. And I'm wondering, is that going to, remove so much liquidity in residential mortgage lending? Will the existing, lenders that are lending in residential mortgage, will they have to raise their interest rates? Right? I don't know. So it's going to be interesting. So the question I have right now is even if the 10-year drops, will mortgage rates go up? Right? Even if the 10-year drops, will mortgage rates go up? I don't know, right? Historically, no. The answer is no to that. But again, when you have a massive, giant juggernaut player just up and quit, things are going to change. Bad things are going to happen. Things are going to need to adjust now. A lot of people leaned on them for that correspondent lending. So there's only 3 paragraphs I really want to read about this article. Here's the first one: more like rivals. Now, as a result of this and other changes that they're making, including pushing for more revenue from investment banking and credit cards, Wells Fargo will more closely resemble mega bank rivals Bank of America and Chase. Both companies ceded mortgage share after 2008 financial crisis. Because remember, you guys, Wells Fargo since about 2016 has been hungry to take over the mortgage market. So the fact that, not only the #1, but the #1 most aggressive big lender has abruptly stopped. That's shocking to me. The slimming down of one of those once huge operations has implications for the U.S. mortgage market. As banks stepped back from home loans after the disaster that was the early 2000s housing bubble, non-bank players, including Rocket Mortgage, quickly filled the void. But these newer players aren't as closely regulated as the banks are. And industry critics say that could expose consumers to pitfalls. Today, Wells Fargo is the third biggest mortgage lender after Rocket and United Wholesale Mortgage. Third-party loan servicing. As part of its retreatment, Wells Fargo is also shuttering its correspondent business that buys loans made by third-party lenders and significantly shrinking mortgage servicing portfolio through asset sales. The correspondent channel is a significant pipeline of business for San Francisco-based Wells Fargo, one that became larger as overall loan activity shrunk last year. In October, the bank said 42% of the $21.5 billion in loans it originated in the third quarter were correspondent loans. Insane, you guys. So that's probably $80 billion of correspondent lending that's now gone. About 80 billion, a year, right? About 80 billion a year in correspondent lending is gone. So it'll be interesting to see how United Wholesale Mortgage and Rocket Mortgage absorb that along with Chase and Bank of America. The article concludes, the sale of mortgage servicing rights to other industry players will take at least several quarters to complete. Depending on market conditions, Santos said, Wells Fargo is the biggest U.S. mortgage servicer, which involves collecting payments from borrowers with nearly $1 trillion in loans, or 7.3% of the market as of the third quarter, according to data from Inside Mortgage Finance. So in other words, what that's saying is right now, Wells Fargo is servicing or holding onto the money. Servicing is essentially a lender holding onto the money, holding onto the loan and servicing it by like sending bills out, collecting interest, right? So you have a lender that lends the money, and then you have a servicer that services that money, because most lenders, remember you guys, sell the loan in the secondary market to servicers like Wells Fargo. So Wells Fargo is the number one servicer, you guys, at $1 trillion in loans. So the shocking thing is not only are they pulling the correspondent plug on so many other lenders, they're also going to start selling the servicing rights to whoever will pick them up, whether it's PennyMac, Bank of America, Chase, Rocket Mortgage, Wholesale United, whoever it is, that is a lot of money for them to pick up if they start selling that. So again, I'm wondering, what if we go into an environment where the 10-year drops, but yet the mortgage rates go up? It's possible. I don't know if it's going to happen, but it's going to be really cool to start seeing that. Now, overall, you guys, here's what I think you do with this information, okay? You prepare right now. We don't know how long we're going to have buying opportunity. There is a lot of demand on the sidelines. We are in this crash from the Federal Reserve demand destruction, right? So the question is, how long will we have the buying opportunity? And I don't have that answer. I don't know. Really, you guys, no one does. But what I am looking at is many factors that are contributing to what I believe is just a continued crash. I am blessed, and hear me, okay? I am blessed. I live in Texas, highest migration state, or second highest migration state, number one in new construction, okay? So I see the rental market collapsing. I see prices plummeting in Austin. I see inventory exploding as well. I understand that not everyone can see that. And if you can't see that, a lot of my viewers know who Jeff M is. I spent a little bit today going over, one-on-one with Jeff, his local housing market in St. Louis. And you guys, the reality is, unfortunately, with like Jeff in St. Louis, that market is messed up. It is not experiencing what I'm experiencing. It's the exact opposite. So this is what I want you guys to focus on: the recession, okay? Understand that historically, we're going to go into recession. We have like 100% chance we're going to go into recession, okay? And we haven't hit that yet. So rest assured, we definitely have more pain to come. In other words, don't just run out and go buy a house just because you think there's going to be no more lending. What you should be doing is focusing on your credit versus who's going out of business. Do y'all understand what I mean? Because if you got great credit, there'll be a line of lenders trying to lend you money. But if you have challenged credit and you barely have good credit, your options will be limited. So make sure that when you go to buy a house, right, and prepare now, that you have multiple options so you don't have to settle. And that's the point I'm trying to make. Now, other than that, guys, I really appreciate you following along with me on this journey. Hopefully, I'll own a house myself soon. I'm going to take you along that journey with me. But in today's video, I hope you got some value, insights, and perspective. And if you're out there investing in real estate, I wish you luck, and I hope you win.